I am very excited to welcome back Kirian Deso von Hest. 2022 was an incredible year for his predictions. On our last year-end update, he predicted the demise of Teladoc. He predicted the demise of Terra Luna. All of it crashed. ARK Invest crashed. Everything has crashed. You were bullish gold and silver physical, not so much the miners. And you have something to say about the junior miners, which have suffered, right? You said
we can go into that.
Yeah, you exercise caution on commodities. So just what an incredible year. Even Tesla, I think you're the only one who was bearish on it in the entire world back then. So welcome
that
back.
I can't remember, but I'll let you speak for me on that one.
Yeah,
I'm glad to be back.
Absolutely. Welcome back. So yeah, we appreciate all the time you spend digging into the darkest corners of these markets, like where most people just can't go, they're constrained or whatever. So really excited to dive into your research. So I guess first up, the burning question is people have realized how centrally planned and manipulated the global economy is, right? You have the Federal Reserve pulling the strings. It's all about the narrative. Will they pivot? They gave us easy money. Everyone got rich. They're taking it away, or at least on the surface they are. And everyone's, all assets just crashing. And so the big question is, what the heck is next, in your opinion, in like the next few months or so?
Well, as I recall in our video at 2020, I said that 2021 would be a bluster year for commodities. That happened. And then in 2022, I said, be careful, because now it's about keeping what you have. And bonds have dropped historically far. I think it's now down like 12% or so, the 10-year, depending on fluctuations. Has never gone down that much, even by a country mile. So what I think is going to be the theme of next year is currencies. And specifically, we've well, not always, but we've kind of known for the past few years that eventually the Fed and the other central banks would have to sacrifice their currencies in order to save their bond markets. And now that the 10-year has inverted with the 6-month to the tune of something like 1.2, 1.3%. It's come back down a little or gone back up a little, depending on your point of view. But it's still the yield curve inversions tend to predict a recession. So if this is predicting recession, it's closer to a depression. It's not been this inverted since the 80s. But in the end, it doesn't really matter. It matters that the 10-year has been inverted this much compared to the 3-month, the 1 month, and everything. The entirety of the yield curve got inverted. Even the 30-year dropped below the 3-month, and even the Fed funds rate. It's below the Fed funds rate. So all of this has to come to a head. Bond market has already said that with the long end going down. And there's two ways to go about this. Either one, Jerome Powell does nothing, just continues on this course, and then eventually the long end will go up, but that is the last thing you want, because it will not stop going up. We'll hit 5, 6, 7% easy, because the CPI is still at 7.1%, even though it's come down a little, and Fed fund rate is at 4.25%. We're still below the CPI. So Jerome Powell talks big in trying to appear like Volcker, but Volcker raised it above the CPI really quickly, because that's what you need to do to calm inflation the fuck down. Because he hasn't done that, CPI might have gone down a little, but all it means is that the inflation has relocated to another part of the market. Look at the Dow Jones. Compared to a year ago, it's down like 5 to 6%. Compared to what happened, and that the bonds went down double that, historically much, why is it still up this much? It's insane.
Right. Exactly.
So what we're going to end up with is that, like I said, either Jerome Powell does nothing, yields explode on the long end. You get an American version of what happened to the UK gilts this year, with gilt yields going parabolic and the Bank of England needing to bail that out. Well, the same will happen with US pensions and the Fed needing to bail them out, which is effectively QE. They're going to drop rates at the same time, because why wouldn't they? And that causes the pivot. If Jerome Powell doesn't do that, then his only other option is to pivot preemptively. So it's going to be very interesting as early as January, because I suspect that the 3 month is now going to follow the path of where we were on previously, when we thought that 4.5% ish would be enough, meaning 75 basis point hikes until December, which is 50 basis points, and then January is 25 basis points, and then probably a pause in February and March before they start cutting rates again, because the forward swaps are still saying that rates will be cut next year. So in January, Jerome Powell has the first opportunity to be Volcker. All he has to do is raise with 50 basis points when the 3 month is telling him 25 basis points. The problem is that it requires him to have a spine, so I'll take the under on that one.
Exactly. So essentially, it seems like all roads are going to lead to a pivot in the first quarter of 2023, right?
I wouldn't say first quarter. It could just as well be summer as it is spring, but I don't think it will be 2024.
Absolutely. Yeah, it could take a few more months, but it totally makes sense what you're saying. We could be reaching the end of this tightening cycle before something just absolutely freezes up and shatters and breaks, and they just have to step in and pivot, or they preemptively do it. And so it seems like in this regard, you can go both ways, because at the beginning of the year, you were super bearish on anything easy money related. But what happens if that easy money returns, right? Unprofitable tech, like what happens?
Just flip the advice. Then obviously anything that benefits from easy money goes up.
Okay, so why shouldn't we invest in, I guess, what is the riskiest asset class? Unprofitable tech, cryptocurrency. Why
so this goes into the general thesis I've been espousing over the past 3 years, and that is that we are already in hyperinflation, but hyperinflation is a process, not an event, because we read textbooks which summarize 3 years into a chart which is this big. You see weeks in a single pixel or 2 or 3. We are living those weeks, hour to hour, minute to minute. So it appears to be going extremely slow. So it doesn't appear like hyperinflation at all. But that is also why the public at large every time keeps getting caught out by hyperinflation. Venezuela is the perfect example. We know there's hyperinflation in Venezuela now. That's no longer news. We're so used to it even. But the people of Venezuela back in 2012 didn't think they would have hyperinflation. By 2016, they were sure of it. So to us, it's the same thing is happening. And that's why I brought up the Dow Jones, because gold historically holds its value. And compared to a year ago, it's up like 2 to 3%. And the Dow Jones is only down 6%. So that should have just done be more. And the only explanation for why it is not more is because the quote-unquote easy money, which is what hyperinflation is based on, has simply relocated into the Dow Jones as it's more of a safe asset, or at least during the last time everybody thought that the Fed was going to pivot up front, the Dow Jones rallied more. It's getting quite volatile. The VIX being at 20 is a fucking crime. So
yeah, it's actually incredible, because like it's so fascinating what you just said, because all the bubble money fled crypto into FANG stocks. Amazon is down, Tesla is down, Netflix is down, Apple's probably the last one standing for now. And so you're right, it just keeps moving into the safer and safer equity assets.
At some point, it's going to go to gold and silver. Yeah. Because there will not be an alternative left. There's no point in buying it. If the Fed pivots and issues yield curve control on bonds, there's no longer any point in buying bonds, because they will freeze it at like 2.5% on the 10-year, which is fine. But at that point, if the yield is already at 2.5%, why would you buy a 10-year? It's not going to go up. 2.5% will be much less than inflation. So you're losing money. So why would you buy it? It loses its functionality. Maybe not instantly, but over time it certainly does. Gold does not, because it's elemental. So as more and more people get the fucking idea, they're just going to start buying up gold, which is going to see the gold price rise up till it reaches a critical point where we run out of inventory.
It's a great point. And it does seem like that's how it works historically. You do have kind of like crashes in the fringe stuff, and then the safer stuff starts to go. And then eventually, in all crashes and recoveries, gold does well. The end of the 2000 tech bubble, the 2008 crisis, gold just always emerges. That's fascinating.
I think I said it years ago, but unfortunately, gold and silver go up last. But when they go up, they're the only ones that stay up.
Right. Yeah.
Do note that it's when they go up, and even 2011 didn't count. It was more of a false start, simply because all the confidence hadn't been lost yet from fiat currencies. Confidence now is at a rock bottom. Nobody believes anything anymore. Trust in general is breaking down. So it's a ripe environment for gold to go up.
You're so right. And it's the most hated asset by far, I think, in the entire market, which is great if you're a contrarian.
Well, not anymore. A lot of shit stocks that you don't hear about anymore because they're fucking dead. Technically, those are the most hated assets. But it's simply the case of, if I predict Forex to die, at least to get volatile, I don't expect it to quote unquote die. We'll get to that in a moment. But if Forex gets more volatile and bonds get more volatile, because now dropping 10% in a year on bonds is not only precedented, we've dropped more. So why shouldn't we go down 10% next year? Give me a good reason. And there's simply not a good reason when you tell others that the US Senate just passed a $1.7 trillion omnibus spending bill. They're going to issue more debt. There's going to be more bonds. Supply and demand. Why would demand go up to compensate for the increased supply? There has to be a reason for that. Some people might give the reason that everybody else sucks more, but not gold. It has an entire history of not sucking in these kind of situations. And that's why I recommended physical years ago even, because if you account for the premiums, which you always have to pay if you want to get physical, it's only gone up. It's fluctuated some bit, but last year when I said I still favor gold and silver, even when I said that it's more about keeping what you already have, I think in euros, the silver was around 23, 24 euros or 25 euros. It was not in a particularly good spot at the time. Now it's above 30. They can't find silver below 30 anymore. And we talk to a global audience on YouTube. It's not just Americans. Even Americans have had to pay more with the fucking Silver Eagle premiums. And that's their government scamming them and keeping the supply low.
Yeah, I'm just waiting for that chart that shows like silver outperforming ARK over like 6 years or something. Because Berkshire Hathaway is already outperforming ARK over 5 years, right?
Yeah.
So
in the end, it will happen, but it's grinding up. It's not spiking up, it's grinding up. Which means that it's going to sneak up on most people.
So interesting. But here's the flip side and why people have hated gold so much, because they say it's not scarce. The miners are shorting gold, right? Because in essence, they sell it as soon as they get it, and it just like floods the market, and they could just get it.
That's a stupid argument.
Yeah.
Everyone, look, if you run a mine, you run a business. You have input costs. So you have to sell down a certain amount of inventory every amount of time. And if you want to pay an expense, you don't want to sell down all your inventory. Yeah, you've got customers to serve. So you've got some amount of workable inventory that you can and cannot save, but often it's not that big. And it's not just a gold mine. You know, it's not that you just pull gold bars out of the fucking ground. You have refiners. Most gold mines produce doré bars. And doré bars are a concentrate of like 70% gold, which is shipped off to a refiner, which makes it into the 99 many 90% purity that you buy in the markets, and then it's melted in the right format, usually LBMA good delivery bars, and then it still has to be shipped to the LBMA or to whoever needs it for, say, jewelry or such, and only at that point can retail buy it. It's just another market business. So why don't they all stack up inventory to the sky? You gotta secure that. If there's a literal pile of gold ore somewhere, what do you think people are going to do to it? Of course, you need security. You have security to some sort of degree, but it's a risk-reward calculation. If you've got 10 million worth of inventory, it's unlikely somebody's going to plan a big heist to steal that because it's still an ore and, it's heavy and everything. If you've got 1 billion in a pile somewhere, you're not going to miss 10 million. Not quickly, at least. That draws thieves. It's not feasible, Better to sell it and then stack the cash.
No, of course. And I mean, I don't agree with that argument because just long-term gold has performed well in these environments, regardless of any argument you can throw at it. So it is what it is.
People don't like gold because it doesn't give them a yield. And people have been chasing yield now for the past 10 to 15 years because we've been living in that easy money periods where yield was easily accessible. And when you're getting, like when the NASDAQ went from 1,400 to 16K, it's basically gone up 11 times if you invested in 2009. Gold hasn't done that. And that's the index. I mean, if you invested in a dividend company that also paid dividend all that time, like Apple, you got even more money out of it. So compared to that, yeah, gold is shit. But gold has a function. So that function has already come to pass over the past 25 years because you compare gold to the bottom in 2000. Around that time, Brown's bottom when the then Prime Minister of England, Gordon Brown, sold a lot of English gold at almost the exact market bottom. That was $200. We're near 2000 now, 1800. So it's gone up 9 times since then. And yeah, the market's done better, but the whole function of gold is to preserve value. The reason it has value is because a gold bar is a gold bar is a gold bar. It's a very non-reactive element. You can swallow gold and you will just poo it out again whole without it having changed a bit because your stomach acid can't touch it. You can, if it's completely clean, you can lick it and it won't have a taste. Usually you have a metallic taste if you lick metallic things, but gold doesn't have a taste because it doesn't react with the molecules in your taste buds at all. It can't break it down to break off these molecules either. So it can't get damaged with wear and tear. It's just bent out of shape. But other than that, if you put a gold bar into a vault, you pull it out 1,000 years later, you have molecule by molecule the exact same thing. Not just the exact amount, but you can also still do the exact same things with it as 1,000 years ago. We still pull Roman coins, gold coins, out of the ground shiny. That is why gold holds its value. And in a situation where bonds lose 10% of their value in a year, you want something that just doesn't.
No, I love that explanation. That makes so much sense. But let's just thinking big picture, because there's a lot of ways to allocate capital. So like you're saying, we're on this big exponential hyperinflationary long-term curve. And along the way, you have this centrally planned manipulation. And so we've seen the people that just go after unprofitable tech do really well. So what happens, like, if the Fed does pivot, won't growth stock like artificial intelligence, exponential age technology, why not consider that in a new easy money environment?
Well, because the Venezuelan stock market is a good example here. You can buy all their stocks very cheaply, but it won't be worth a goddamn thing because the companies aren't worth a goddamn thing. So in this process of hyperinflation, technically speaking, everything will go up. But what you're going to see is many companies will not be able to outrun their input costs because everything is going up. So far, we've seen commodities spike quite a bit, but that is according to our historical values, which is like 40 years of easy money suppressing the price of commodities as well. They've gone up, but not spiked. You look at nickel, you see what happens when metal really runs out. Nickel went parabolic this year, or last year. I don't know. I think it was this year. In any case, if that happens to copper, everything that's derived from copper, which is anything electrical that has copper wiring in it, it's ubiquitous. It's everywhere. All those prices will also go up because it will just be passed on to the consumer. That's going to cause the consumer to hunt for a lot more money, which is inevitably going to cause the government to print it. And it's just going to perpetuate the inflation cycle. So because the raw input costs, even energy, are going to go up in price, and not every company will be able to sell as much as they did because the people will not be getting their income. Their income will not compensate for high inflation. We've seen that already with wages not going up as fast as 9% inflation. Well, it's very easy to understand that wages aren't going to keep pace with 20% inflation. Not with 30, not with 50, not with 100, if they already lag out on 10. So because of that, people are going to have more money, but less purchasing power. So less spending capacity per unit of currency. And they're trying to compensate for that with more units of currency, but because everyone at large can't, because somebody has to take the hit of all this debt we ran up, because those people can't, well, some companies are just going to drop in sales. And the companies that are going to go first are the unprofitable tech, or maybe not specifically unprofitable tech, but any company that is already unprofitable as per sales. You know, the companies that have the zombie companies that need to run up more debt in order to stay in business. Even though the debt servicing capacity and the more lending capacity is there, the input costs to make whatever they sell at a loss also go up, which makes their loss selling even worse. And as their losses accumulate, while everyone around them starts, being more and more careful where they put their money, at some point the lenders are going to say, you know what, if I just lend the other guys more, I'm going to keep pace with inflation. But if I keep lending you more, I'm not going to keep pace with inflation because your sales are not keeping up. And that is how hyperinflation returns us to normalcy anyway, through a much more brutal process than just a recession every couple of years. Because it's just going to, the lenders are each individually going to say, these guys are beating inflation, you guys are not, I'm going to put my money there because I can get even more.
Right. And so that goes back to the argument of, historically long-term, which assets do beat inflation in this centrally planned economy. And it is the ones that have massive growth, right?
Well, that's why I keep saying physical gold and silver, because once the price goes up through there being a shortage created, because demand slowly increases over time anyway, like I said, it's been grinding up. It's not been going down, it's been grinding up. But eventually that grind gets big enough to cause an actual shortage or a price spike. Something like the silver squeeze, only then bigger. Like we finally break 30 for good and we go towards 40. That'll get people's attention. Once those people get once the silver price starts drawing everybody's attention in, that's when it also starts drawing in extra demand. And then it becomes a very simple supply and demand equation. How much more supply is coming online within short term, and how much more demand is coming online in short term. Now, stuff like the comics can do stuff like increase margin limits and such, but that doesn't matter when they don't have any metal. And the difference with commodities compared to anything else like stocks is that there is no circuit breaker, there is no price limit. If you need silver for your business or you go bankrupt, you will pay whatever you need to, except for everything to go bankrupt, in order to get that silver.
Yeah, and so let's talk about that because this is such an important point that so many commodities investors miss, right? And we talked about it off camera. It's like if you want to take advantage of the rising prices and the utility of these commodities, most people like to just go into the riskiest possible
Oh
mining.
God, yeah.
What is the danger of that?
So the reason we talked about it and we bring it up again is because during 2021, and I, got my start in the silver and gold space, and I did stock advice on Twitch and such, looking at stock companies. Just throw it a ticker and I'll look at it. And I've done that for quite a while until the last video we did, and it said there's just no more deals out there, so I kind of stopped doing it. The stocks that I got asked about the most, so that I saw pop up the most, were always explorative juniors, which means that they don't even know how much they have in the ground. They know they have something because they're getting positive drill results, but they don't know how big the resource is, how much they have of it, how much it's recoverable, what the geology is underground, and any kind of dangers or inefficiency they might run into. All those things. None of them. They have none of them. They don't even have the first pre-feasibility study. They're working on it. The times that people ask me about a major were zero, even though I recommended Yamana.
Right.
And Yamana is now involved in a takeover battle where first Goldfields Limited was supposed to take it over, but that deal fell through, and now they're going to take over or merge with, I think, Pan American it was, simply because they bid more. They bid beyond the fucking penalty for letting the other deal fall through. That's how fucking valuable the company is. Stock price doesn't matter. The market can very much be wrong. And obviously, one company is not the entire market, but the point I'm trying to make here, and that's what I said at the time often enough, and that is, there's nothing wrong with writing dividends up. Because in case it doesn't go up, at least you get dividends on the way down as well. You average in more, you get more dividends later. And if the explorative juniors do well, then it's probable that the majors are doing well as well. And you look at the free cash flow of those majors, they're monsters. They're crushing it. Like you said yourself, they're doing very well. They have not suffered at all. So the explorative juniors have gone down, but that is, you have to remember that first they need to find how much they have. They have the first step. They have the very first step. They know they have something. Then they got to find out how much they have. They got to make a study out of it to see how much of it's recoverable. Then they got to find an investor to either start up the beginning, which is usually a capex spend of a couple of $100 million. It's just not easy to get. Or they have to do even more studies because they found stuff during the first study which warrants more study. Like even they find an offshoot of a vein, or they find some trouble. They need to define specifically how far does this one go down? Do we do open pit or do we do an underground mine? All those things need to be studied and thought about because geology isn't simple. It's not crypto. You're not printing free money here. You have to work for it. So right. After that, after all that's been complete, you have nothing. Nothing. It's in the ground. It's in rock. You need to get it. So that's when you need to find an investor to actually get your mine started. That's when you get your mine started. You buy your equipment, you buy your mill, you make your contracts with your refiners to make the doré bars into actually refined bars. So it's worth something because doré bars are still worth nothing. You can't make a doré bar into jewelry. You need to refine it into 999 fine gold. All these things need to happen, and the investors get diluted every step of the fucking way. Majors already went through all that. They're literally pulling gold out of the ground. They might even have a refinery themselves, and some of them, like First Majestic Silver, are literally selling directly to consumer. You want to support companies, like you want to get away from ETFs and scams and frauds and SLV, pure paper. You want to support companies directly. This is a fucking silver miner that just sells bars on their website. So you support that, more miners will do it.
It's so refreshing. Yeah, because the commodity space is just filled with people hawking these just unprofitable companies, extremely high risk. And you're right, people just get diluted the whole way there. I mean, maybe in a bubble environment they'll do well, but yeah.
When the easy money comes back, these companies will do well, and many more will find capex in the biggest capex spend you will have ever seen. I've been talking about this for more than a year now. I forgot who, but in the past year, I saw somebody else make the exact same argument on Twitter. So I know other people are starting to get the fucking point. The reason you get this capex spend is because when the gold and silver runs out, where are you going to put your money? Now, your obvious logical alternatives like platinum, maybe palladium, are going to go up as well, but they're going to run out much faster because it's a much smaller market. And you're going to run into the same problems, going to be pulled out of the ground. Copper can do the same thing. It used to be money too, but it's more difficult to store because it's more prevalent. And if copper runs out, again, it's everywhere. Everything gets more expensive. It will happen eventually, but let's not let it happen immediately. So what do the rich people do? Especially since gold and silver still have such a low price that if Warren Buffett puts in 1 billion today, he loses all his other billions because they could become worthless because the price of gold goes up so much. You spend the capex on the initial capex spend for a mine. What does that buy? It buys you a huge fucking truck. It buys you drill explosives. You know, you got to explode the rock and then collect it. It buys you the fuel to run all these things. It buys you maybe a mill that you can construct yourself if you go for a bigger plan. If you don't make a deal with somebody, but you construct it yourself, you can do everything on site, and you can even service other people. Because remember, the people that make the most in a gold rush are the people that service the miners, not the miners themselves. The people selling apple pie. And to remember the famous story. So, I would be bullish on mining companies, or not mining companies, but mining supply companies. So think Caterpillar. Another company I've heard about before is Geodrill. It's more of a junior, but they still supply equipment to mines. So if people are going to supply, or people are going to throw their money at mines because they can't throw the money at the metal itself, and they just elect to accumulate metal over time, because if they own the mine, then they can just, anything that doesn't need to be sold for input costs can be accumulated. Plus, because gold is going to get in more and more and more demand as more and more people seek to preserve their purchasing power, it starts to outrun inflation. Because it compensates for inflation due to it being an inert metal, thus it keeps its value. But because demand increases and supply stays the same, price still goes up.
No, the long-term thesis that you just laid out makes so much sense in terms of the demand and the supply and everything. But I'm just trying to think like really deeply for the people that are listening. So they can allocate their capital. We're in a hyperinflationary environment. You do have these long-term commodity that just bullish fundamentals in terms of the input costs. But there's also emerging technologies, right? We've been in a bubble economy for the last 20 years. What has Amazon done in the last 20 years, right? So people can consider revolutionary new technologies like small modular reactors, right?
They ran up 100 billion in debt. That's what Amazon has done in the past 10 years.
They have $100 billion in debt.
Compared to the other companies, they're not negative net debt. So Google's got so much cash that net speaking, they have no debt. But Amazon's not the case because they've got massive warehouses, a lot of land, many employees.
Yeah.
Out of the big four, being Microsoft, Google, Apple, and Amazon, Amazon's the one that's going to collapse the hardest. Apple's going to go down too because $2.5 trillion for a company that basically makes a phone. It's too much.
That's what I'm saying. I think that's the last shoe to drop in this bubble. Yeah.
Yeah. Maybe everybody flees into it for safety, but once everybody is on the same side of the boat, you already know what's going to happen.
Exactly. Yeah.
But Amazon is probably the one that goes sooner because if it wasn't for the cloud services, they would already be in deep shit.
Right. Exactly. So
that market only grows so far.
That's what I'm saying. Yeah. So you have these emerging technologies and people can allocate their capital into commodities or they can allocate it into growth sectors like, again, small modular reactors. Like in this hyperinflationary environment, Amazon has made people filthy rich. So why not find.
Let's go into uranium, shall we? Because I know your
Yeah.
viewers are chomping at the bit for it.
Yeah.
So yeah, sure, uranium will still do very well. I know it's gone down in the past year, but again, that's just your fucking explorative juniors that you just had to put your money in, and that's not the market's fault.
Right.
Look at Cameco, them taking over Westinghouse, and then Westinghouse getting the contract to build 6 new reactors in Poland. How fucking bullish is that? Compare that to 2020, okay? I was already talking about uranium in 2020, saying that it was going to go up. And the only positive thing that happened back then was a website change in somewhere in the back of the Democrats' party website that they were no longer against nuclear, even though that bit against nuclear had been there for 37 years. That was pretty much the only kind of change. And the US has lagged behind as far as it went into a nuclear future. They've invested more money. They've invested more in small modular reactors. The most recent news is the continuing of the uranium strategic reserves, which contracts have just gone out. The first contract going out to fucking Peninsula, which is the company I bet on.
That's right.
So I hit a maximum bullseye on that one for American domestic supply.
Yep. Yeah.
And that's a junior. Okay, that's not a major. That's a junior.
Did the price move on that?
I don't know. I don't think so.
It should.
The market is sometimes just wrong. There's this thesis out there, the efficient market hypothesis, that the price in the market is right because the market is the one with all the information. New. It's based on emotion, on the group dynamics of a large group of humans, which are always working with imperfect information. How many wrong analysts have you seen out there? I'm one of the best out there by now, and I'm wrong quite a lot. Maybe not on the big stuff. Maybe I haven't made any big fuck ups yet. Although the Gazprom shares got locked up. So that was a war. Hey, it's Christmas and Putin isn't flat yet. I did say that once it got started, that this wasn't going to be over in 2 weeks. So, and it isn't going to be over next year either. Well, Zelensky wants to free all of Ukraine, and he simply doesn't have the manpower or the equipment to do that. Taking back Crimea is a pipe dream. It's not going to happen.
Well, the U.S. military-industrial complex is happy, though.
Yeah, of course they're happy. I mean, what America so far sent $100 billion to Ukraine, which exceeds the Russian military budget for the entire year. Thanks to this, by the way, Russia is now expanding its standing military to 1.5 million. So thanks, America. The world's gotten a lot less safe. It hasn't really helped. Plus, the battle lines haven't much changed since the initial start of the war. Ukraine got Kharkiv back, which is good for them. Big strategic victory. But Russia's also thrown another 300,000 men at it, and they can do that many more times.
Yeah, I think Ray Dalio said that this is a cycle of empires. Like the military-industrial complex feeds the government and vice versa, and it just builds on itself. So I don't know.
Until it collapses. It has to collapse, and you see that what's happening in the rest of the world outside of the American sphere, which is quickly de-dollarizing really quickly. The biggest events there are this year. China is starting to convince Saudi Arabia to start selling oil in yuan, so the petrodollar is basically dead at this point. I mean, it's dying; it's not gone yet, but it is going away. BRICS has expanded. I think Argentina that was the one that officially applied to join. Other nations as well. So that is rapidly evolving. Fucking Ghana has now dictated that their gold miners need to sell 20% of their gold to the government for local currency in order to start avoiding their currency depreciating to attract dollars. Because Ghana's two biggest exports are oil and gold. They produce it themselves. This is the Russian model. The Russians also since the 2008 crash, and maybe before, I don't know about that, basically forced their miners to sell all their gold to the central bank, which gave the gold miners a guaranteed buyer, while it increased the gold reserves of the central bank, which in the future is going to back the currency. Recently, the ruble has dropped a bit against the dollar, and the reason for that is because it hasn't been as cold in Europe as we might have expected. Gas supplies are quite high. October has been very mild. So we reached 95% gas supplies full. And aside from inter-country differences, like the UK doesn't have a lot of storage capacity. If we have even one more cold snap, they're going to run out, probably, very quickly. But the rest of Europe is a different matter. So if we get a mild February, we're going to be just fine. And the market is reacting to that. So the gas price has gone down, but because the ruble is based on the price of gas, because you need to find rubles in order to buy more gas, once that flow into rubles stops or slows down, the value of the currency drops. In my books, I write about this specifically. I have a whole chapter dedicated to energy, because basing a currency on energy is a horrible idea. It's not that energy doesn't have intrinsic value. It's that you cannot determine the intrinsic value of energy up front, because you don't know what you're going to use it on. If you have a barrel of oil and you convert it into petroleum, you use it to drive cars and drive mining equipment and everything, then it clearly has value. You pay a price for that. When you take the same barrel of oil, you light it on fire, and you just stand around it for heat, then it has much less value, but the same amount of energy was used anyway. It was just wasted. So technically, we wasted quite a bit of money buying up so much LNG going into the winter, because we're probably not going to need it all. But we didn't know that up front. We're not perfect.
Okay, so I guess bottom line here is that we're having this slow hyperinflation. The Federal Reserve might pivot. You're saying slowly but surely the weaker companies will still just die off and get strangled as input costs become too much. They can't handle the hidden inflation that's nascent in the system now. And so, so then just going back to, some companies will beat inflation, right? And historically in this bubble economy, you have had high growth, like Amazon, right? Microsoft beating inflation. What happens going forward? I know you're bullish commodities, but is there any sort of revolutionary new technology like SMRs or AI that will absolutely crush it? Yeah.
Sure, absolutely. Which company? Can't tell you. It's that simple. Some companies will beat their input costs. A good bet would be NewScale, but at the same time, I recently read that their local test in Wyoming, I think it was, where they are turning a coal plant into a nuclear plant, that has been delayed for 2 years, because their initial fuel load was coming out of Russia, because the Russians refined the uranium into what we need. Same thing as with gold. I told you, the uranium mines are effectively producing uranium doré bars, only then it's called something different. Then you send it off to the refiners, and they turn it into yellow cake, which is the base ingredient for a uranium fuel pellet, which also still needs to be made. So which companies? Yeah, the SMR technology is great, but if you can't find the fuel to run it, what good is it? Then the company's not going to grow.
That's why you like the raw input commodity assets.
Well, uranium to begin with, because it's just another commodity that we dig out of the ground. And I know it's fairly prevalent in the ground, but there's a time discrepancy between when we need it and how much we have of it above ground. So plenty of companies will do fine. I would just stick to the majors or anything that produces. Like Peninsula, like I said, is a junior producer. Or, I looked into them, and they were upgrading their technology to be the lowest cost producer via the lowest cost producing process. That's why I think they're undervalued, but they're still a producer, a junior producer, a small one, but a producer. So, yeah.
Guys, no, trust me. My takeaway is look at Peninsula, because the U.S. government is now subsidizing these mines. They're paying them to get uranium out of the ground.
It will be more. They at some point the U.S. government hasn't realized the refining problem yet, but they will. Probably in very short order. And there is no other way out for CO2 free power, baseload power, than uranium. Wind and solar might have their place, but it's intermittent power. It's not baseload power. You can't. Europe is firing up fucking coal plants. Okay, if it would have worked at any given point, it would have worked in Europe. Right now, it's not working. So we're going to go into nuclear plants anyway. America will want its own domestic supply, and it doesn't even have one because last year it mined, or this year, well, this year I don't know yet, but last year it mined 0 pounds locally. Even Peninsula isn't currently producing anything. As I said, they're doing testing and upgrading the process, which is very bullish for the future, but not right now. They're simply buying in the open market and selling it onwards with a fixed contract book. These fixed contracts are already around 60, 70 pounds uranium, far above spot. Spot's just catching up to where we already are. That doesn't even account for what happened recently is that the Japanese government has okayed the restart of their nuclear fleet. So Japan's going to come back as a buyer on short notice. Why are they doing this? High electricity prices. Look, we might have to wait for reality to do the right thing, but in the end, we have to do this because otherwise we go cold.
Absolutely. So again, if people listen to you at our last video, you were talking about shorting unprofitable technology. I remember you even said short bonds, which was on the Widowmaker trade, right? Not this year. And so I want to get into your big trade ideas. Obviously not investing advice at all, right? But, you were successful in 2022. I want to get into kind of what excites you so much to start thinking about in 2023. The VIX is interesting. Is there something going on in FX? Like what really, gets the juices going for 2023?
Collapse of currencies. They're going to have to start saving bond markets. The Japanese recently raised the yield curve to 0.5%. So they yielded, pun intended. But they were always, they could have kept it up infinitely, but then the amount of money that they're printing to keep it up infinitely is going to drop the yen. And that's what we also saw happen this year. The yen go to 150 and pass it. And at that point, they intervened. So they can only intervene so much because this is the end game. Like they have to either sacrifice the bond market or the currency. Japanese sacrificed the currency. It went too far because nobody else is sacrificing the currency at the same time, and that was their problem. See, if the Europeans and the Americans and all the other major currencies are printing at the same rate at the same time, it keeps its relative value. Yes, gold goes through the roof, copper goes through the roof and everything, but you can manage that in different ways. The DXY would go sideways. So the yen would also go sideways. And that's how they would keep relative value while saving the bond market. But it can only happen if everybody does it at the same time. Now, thanks to America raising their rates and Japan having such low interest rates, they were kind of forced into acting before everyone else. And they've now changed it into having the bond market and the government budget suffer a bit more. Because on that front, even though they've been doing QE a lot longer, American interest payments on the national debt have already started going parabolic. So the Japanese ones will as well, but it's now a game. And I think in 2023, the US government is finally going to realize the shit that it's in. Because so far, even though interest payments on the debt have already been going up, it's not much of a problem simply because GDP has also been going up. It's the first cycle of hyperinflation where you print a fuck ton of money, but it hasn't been spent yet. It will be spent, but that takes a while. It takes a while to circulate through the economy. So because it's eventually spent, then purchasing power is lost, but in the beginning it doesn't happen yet. That's going to happen now. That purchasing power is going to get lost because the governments are going to need to save the bond market. Otherwise, yields go through the roof. Market collapses. Used car markets also collapsed. So if you want to get a cheap car, I have it on good authority that repossessions are coming in 2023 and are going to be major. So if you're in the market for a not that used car, even Carvana will probably die as well, finally, because a fucking car vending machine. Are you kidding me?
Right. You're saying they're going to have to save the bond market, and that's going to cause a collapse in fiat currencies generally.
In general, well, it depends on who does it first. Like I said, the Japanese did it first, so the Japanese collapsed first. If everybody does it at the same time, the DXY doesn't collapse, but gold and silver go through the fucking roof. It always comes out of somewhere. There's no free money. There's no free purchasing power. It always comes out of something somewhere. And if you keep that process up for too long, the entire system is in danger of collapsing. And that's what we're going to find out now. So is the DXY going to collapse, meaning the dollar itself? Could be for a short period of time. If the American stock market finally goes through the floor, they finally give up front running the bailout, well, then it ends up getting bailed out. And that's when America sacrifices its currency before Europe does, because if Europe doesn't have to freeze its bonds, that's most likely the thing that's going to kill Europe. You know, Italian debt finally going out of control. The Europeans will have to engage in yield curve control too to keep that under control, and that's when they are printing euros. But if there's a time delay between those two, then first the DXY collapses, and then it spikes again. What I want to emphasize here is that this entire process has already been observed in markets this year. It's no longer stoppable in any sense. And what I'm talking about is that in March of 2020, I was there for the collapse. I was there for the DXY spike. I saw a lot happen. And back in those days, to see the DXY up by 1% in a day, very rare. We're talking a global pandemic, an unknown virus spreading across the globe, and that caused the DXY to spike by more than 1%, a little over percent, about twice. We've already seen the DXY do 1.5% either up or down in recent times, multiple times. And the market hasn't even collapsed yet, it's just fluctuated. So logically continuing that pattern, it's not a sense of the DXY will collapse, it's a sense of the DXY will get fuck ton more volatile. So this is not a market for rookies to trade in. Really not. Stay the fuck out. Just buy physical gold and silver. Wait. Sometimes the hardest thing to do is wait. You can look it up from all the greats, Stanley Druckenmiller, Warren Buffett, Charlie Munger. They all say sometimes you just have to wait. This is one of those times. You buy safety, you stand the fuck back and watch it explode. That's how you sleep soundly at night and you save the rest of your life. But if you happen to be a day trader and you want it, or you want to be one, and this is the perfect time to get a baptism of fire, then what you do is you keep your stop losses real tight. Don't be like Caroline Ellison from Alameda and say that stop losses are not a good way to manage risk. Are you fucking kidding me? It's better to be blown out on one of these spikes and miss it, because there will be another one. Your main objective as a trader is not to get on the big spikes. Your objective is to avoid the big ones that go down. You can be a winner for years and lose it all in one bet if you do the wrong bet.
Yeah, it's very true. So I guess that what I'm trying to understand here is there's a dynamic where the Federal Reserve just has to whisper one thing dovish and everything goes up. So why would...
That is the volatility.
Right. So why would this time be different where all of a sudden there's a loss of control in the bond market when literally just every little whisper...
Well, nothing is different. It just gets more volatile. So like I was saying, at first, 1% was unique, 1% change in the global reserve currency. Let's get that reminded here, people. It's not, this is not a shit coin. This is not a third world country. This is the main trading thing on the planet that's supposed to be stable in value. It's going up 1% or down 1%, like nothing. And that was 2 years ago. Now it's 1.5%, and I might have already seen 2% or come close to it. The pound, another major currency, it might not be the biggest, but it's a major currency. During the gilt crisis, well, they went down what, 5% in a day? This is 100 million people relying on that thing. It's insanity. Except that it's not, because what we're going to see next year is going to get much worse.
So I guess, yeah, I'm trying to understand why is the volatility, I know it's been doing that, but like why next year? Will the bond market force it because of inflation, or?
The bond market forces for various reasons. In the US, it would be well, let's get this right. Well, for the US, it's the national debt, the interest payments on the national debt. And in the next April, because now with crypto having gone down, they're not going to get any crypto taxes. They're not going to get any real estate taxes because they all got fired. So I expect that by June, maybe, messages are starting to come out that the US government didn't collect nearly as much taxes as they expected to. Yet they still ran up all the debt that they did, which means they're going to cover the differences with more lending, which means that the US government deficit next year is going to blow the fuck out. The only thing keeping that thing down now is relative value, because the US government keeps collecting the easy money taxes. But the easy money's gone away. So the easy money government taxes also have gone away. And the government hasn't realized this yet because tax season is in April in the US. So that's their fundamental driver. In the UK, it's the gilt crisis is just going to come back because they only bought more bonds temporarily to bridge the panic. But the Bank of England is still planning to QT, meaning sell more bonds into the market, which is going to drive up yields at a point where the market can't take that anymore. And the UK mortgage market is much worse off than the US mortgage market. Because in the US, it's almost all of it, 95% is 30-year fixed rate, which means that the people themselves are not going to get in trouble with hyperinflation and everything. But the other end of that trade, meaning the banks holding these mortgages, which are now nowhere near compensating for inflation, they get fucked. So you get a 2008 crisis anyway, just in a different shape and form in the US. But in the UK, where everybody has variable, it's going to be the classic 2008. We should have learned and made everything fixed, but they didn't, so everyone's screwed.
Gotcha. So you're saying it's yield curve control. They're going to have to suppress yields in the bond market, and that's going to, you're saying that's going to cause a loss of faith in the dollar, which is going to cause it to collapse.
Not just the dollar, but in this case, in this example, since the UK has to engage in yield curve control to save its own pensions, they will just have to continually buy up more and more of the bonds that everybody wants to get out of, because everybody realizes this is the end. Where are you going to put that money next? Well, commodities. So in British pounds, commodities also go through the roof. But for example, I don't know if Switzerland has a housing bubble, but let's say for the sake of argument that Switzerland will be absolutely fine. That means that the Swiss franc will be absolutely fine. So that means that compared to the dollar, the euro, the yen, the Swiss franc is going to go through the fucking roof. Like you might see 10 francs to $1 or 100 francs to $1 because there's nothing wrong with their economy or their currency. They don't have excessive debt. They don't have a real estate bubble. Again, for the sake of arguments, because I need one country and I don't know anyone else to pick. So that is why I referred to the Dutch housing bubble and the Canadian housing bubble earlier, because in Canada, even though they also have they also have national debt, the Canadian national debt, as far as I know, is nowhere near as large as the American national debt. That also means that it cannot possibly function as a fundamental driver for hyperinflation. However, the Canadian housing bubble is so much larger than the US one that trying to bail everybody out of that bubble, also with, again, 5-year fixed rate maximum being the normal way of doing things. I also read that in 2021 or in 2020, I think 25% of the age category between 20 and 35-year-olds bought houses. That is the worst credit category. There's people who never had the chance to build up finances in their life yet. 25% of them. All of them are fucked now. There's only one answer there. You got to bail the whole system out.
Gotcha. And so the unknown here is, to what extent does the market lose faith in the Federal Reserve's ability to do that yield curve control?
The Fed follows the market. And this is very important to understand. We talked about that earlier, how the 3 months was ahead of the Fed and the Fed's following it. So you have to understand that's always the case. Always. Right. They're not reactive. They're not proactive. They're reactive. And that's why January is so interesting, because if they go for a 25 basis point hike, that signals that they will continue to be reactive. They're basically saying, we're the market's bitch. We will do whatever you say. And if the market says you got to cut rates, they will.
Right. That's true.
That's why we will get a rally, because everybody knows this. And that's basically the Fed pivoting. That's as good as a pivot.
Yep.
Because the market then only needs to create a situation where the Fed will pivot, and they will, because we then have that security.
Yeah, no, that's a great point. So you're saying if the market forces rates higher, the Fed's going to, or if the market forces inflation higher or whatever, the Fed's going to have to be reactive and continue to just deal with the mess that's made.
The market doesn't know the full picture at this time. The bond market smells trouble, but it smells a recession. It doesn't smell hyperinflation yet, because we haven't gotten to that point yet where hyperinflation is obvious to everyone.
Right. So you're talking about pretty much escalating the end game into 2023, because you're saying a loss.
This is going to take a lot longer than that. But, this is a 1 year ahead video.
Yeah, exactly. It is. And you're saying the volatility will really start to pick up in 2023 in the reserve currency, not necessarily a full out loss of confidence. I got you.
The curve will start to go exponential.
Yeah.
So if you look at a exponential curve versus a linear curve, you will see that it stays flat or observably flat for a very long time, but it goes up a little bit. And then at some point it starts to curve up, and then it goes up vertically.
Right.
The vertical part is what everybody remembers as hyperinflation. But in order to go vertical, you need to have done this and this and this and this.
Exactly.
We are now here. 2023 will end like here.
Gotcha.
So everybody will see that something is up. This is not your normal recession. Yeah. That is, I've talked about the three phases of hyperinflation before. Phase one happened in early 2020 when they just printed 2 trillion in March and April, and then did 200 billion a month from then onwards. It's just a lot of money. That caused inflation in 2021. And that has caused the second situation, the second phase to develop, in which we are still in. And apparently it just takes a while for it to pass. I didn't know that either. I'm learning this as I go along. And that is hyperinflation, even though it's fundamental. It's a fundamental driver. And that fundamental driver has been there since the repo crisis. Even though it's fundamental, at some point people realize it's fundamental. Like you slap somebody 20 times in the face, they're going to expect a slap. So over time, as more and more people start to realize that something is fundamentally wrong, the whole idea of front running things still exists. So they just start front running what they now realize is inevitable. And that is the thing that makes the curve go exponential. So it appears that hyperinflation is psychological and a self-fulfilling prophecy, because the third phase of hyperinflation is that purely psychological phase where everybody's constantly front-running everybody else. But it's only there because of an underlying fundamental factor. It's the same factor which if and we've seen this many times in third world countries that hyperinflated, where they either cut off zeros from the currency and say, okay, now we're going to do things differently, or they introduce a new Zimbabwe dollar, and it doesn't work. Like it stays stable for like a week, and then it just goes hyperinflating again. That is not a loss of confidence, because how can you lose confidence if you don't have confidence to begin with? You can't lose trust in something you don't trust. And if you don't trust the government and the government comes with a new coin, nobody's going to trust the new coin. So if the new coin doesn't have some sort of fundamental value backing it that you can trust instead of the government, it's never going to work.
So you're saying the tremors will just start to pick up a little bit. We're starting to enter that exponential phase. It's going to take years, but we're starting there.
This actually ties into something we're going to see in 2024 and later. Well, we might see the beginnings of it in 2023 as well, and that's CBDCs. So central bank digital currencies. When they announced the digital dollar, they already said that it would be on the liability side of the Fed's balance sheet. That makes it a loan. The current dollar is already like 99% digital and is also a loan to the Federal Reserve. Ergo, nothing changes. The only thing that changes is that cash goes away, making the whole system digital, meaning that there is no longer a physical limit to how much they can depreciate the currency. Because, and this is true, multiple hyperinflations in history have been stopped because the government could no longer afford the imports of paper. If you don't make the paper yourself, you got to import it. And if foreign governments won't take enough currency so you can import the paper, you can literally no longer print money. You can't afford the ink, you can no longer print money. So if the currency is completely digital, that limit goes away.
Mm-hmm.
I even wrote about this in my books talking about video games, because there's a particular type of genre out there called idle games, very popular on phones, that basically going to go play themselves, where you earn a ridiculous amount of currency, but the upgrades that you have to buy are so much more expensive that even with a hyperinflation curve, you hit a ceiling. You literally hit a linear exponential ceiling. And that's the point where you prestige, get more permanent bonuses. So the next time you can do it even faster, get even higher numbers because it's fun. But in CBDC, you can implement that system in real life because there's no limit to how much you can print. Well, there was one thing, now that I remember it, that kind of sort of came true, but not exactly as I said it. Along the way, I said I wouldn't sell gold and silver stocks because I didn't expect them to go down. That was wrong. They have gone down. But the asymmetrical crash that I said would happen, that not everything is going to go down equally, that has happened. Like I said, the Dow Jones is only down 5%. Some commodities are up. Can't really remember which one or which ones don't have any example, but not everything exactly has gone down. Gold is still up 2%. So it goes out, it's gone sideways. So, yes, the asymmetrical crash has happened, but anything and everything that was considered risk off, like explorative, speculative gold juniors, have done horribly. And because of general market sentiment, it's also dragged the majors down. Like I said, the market isn't always right. It's more wrong. It's often more wrong than it is right. I mean, think about it. If the market was always right, there'd be nothing to trade. The price would move
every day. Yeah, it changes its mind every day. So obviously, it was wrong the day before. So.
Yeah, it's if the dollar goes up 2% in a day or down 1% in a day, doesn't mean that suddenly 1% of the supply of dollars went poof.
Right.
The same with gold and silver. The same with any commodities. It's just fluctuations based on perceptive value, what people think it's worth. Because it's not written down anywhere. God didn't put prices into stone for us. We kind of have to guess. And people are horrible at guessing. Horrible.
Right. So you're calling for a Fed pivot, volatility in the currency market, strength in gold and silver, 2023.
Absolutely. I think it's finally gold and silver's time. Uranium and such as well, because in the end, it's just another commodity that we dig out of the ground at a deficit rate. Which means that the more people that discover that, the more people invest in it, the higher the price will go. Things like SPOT, like the Sprott equity fund that buys up supply and locks it away, that's a thing now. The more people invest into that, less supply there's available. So that's still bullish. And finding a good SMR company is also very bullish, but I wouldn't know which company which. I urge people to do deep due diligence. We're not in a situation where you can just do a light look at the balance sheet and you're fine. If you want to you want to be an early investor in speculative technology, you have to know everything there is to know about that technology. You need to be able to tell me within a minute which one of 4 SMR companies is the best one and the exact reason why. Not just the reason why that one's the best one, but the reason why the other 3 suck. If you can't do that, you shouldn't be in the space. If that's a very high bar, well, guess why there's not that many rich people out there? If it was easy, everybody would be rich. And then nobody would be rich because rich is a relative concept and only a few people can be rich at any given time. The rest is poor.
Right. What about the 3D printing ETF?
God, I wouldn't go into that. No, see, 3D printing housing is a longer term game based on the idea that whatever happens, see, now there's a lot of houses under construction that's going to hit the market, that's going to drop the price of houses tremendously. But that also means that in 2 or 3 years, when the price has completely crashed, people are going to start looking for lower cost alternatives to build houses. If 3D printing houses is that lower cost alternative, that company will still do well, despite every other building company doing poorly because they're still working with wood and not some printing substance or whatever. So that's a very long-term basis. That's not even something I would say buy this or that stock, because they will still dilute themselves to keep themselves alive until that market goes off. But it is something that if you want to be an early stage investor, you also are an early stage researcher. You have to look into the market, stay up to date, look at the developments, because if you look at the developments you read in the news, you can build your own timeline in your head, and you can start making estimations of when is this really going to take off.
Absolutely. Love that. Yeah. Well, hey, if you want to add anything else, do so.
There's so much to talk about. I mean, we haven't even talked about crypto in depth, have we?
No.
I mean, that's pretty important because I'm pretty sure that market is going to die in 2023. Well, it's not the thing that crypto is going to go away. It's just that the frauds are finally going to get cleared out. So FTX is dead now. While I didn't call FTX specifically, I didn't say anything specifically about Sam Bankman-Fried or anything. That's more or less because I consider it to be I considered it to be taken down in the way that it was, that there is shenanigans going on, but you're only ever going to get a true, undeniable look at the shenanigans if you see their balance sheet. And what happened? Their balance sheet leaked out. There was a fit. CZ said, I'm going to sell my tokens, but that's just what anybody would have done when they saw that balance sheet, because holy shit. And FTX went under in a week. I want to keep this in general because all the crypto are going to die. Binance is now systematically being dismantled by the crypto skeptics, not because we want to see this thing die, but because there's a lot of shenanigans going on there, and it's being exposed a little bit more every single day. It's quite something to see. I didn't think I would ever see this. I thought it would all just collapse on its own before this. But the community is hard at work at exposing all the fraud. We've gotten to the point that somebody is starting to run BNB chain or BSC chain. That's the Beacon smart chain from Binance. They've run a validator, and they're getting error messages from the validator. That means that it might not even be a blockchain, because a blockchain is block after block after block after block. And if one of those blocks isn't correct, then everything that follows isn't correct either. Like, this is early research I saw on Twitter. The skeptic community is hard at work at exposing what exactly is going on there. The actual circulating supply of that thing might not be more than 10 million BNB on a total supply of, what is the 150? So if most of that moves, you get the same thing as it was FTT. We don't know how much of it's on the balance sheet of Binance, because Binance doesn't give out that information. They've given out the proof of reserves, which are now useless because they don't line up.
Really?
Yeah, on their own proof of reserves page, not everything lines up.
I thought, okay, so this is my understanding. They have tens of billions of dollars in one-for-one backed reserves. Am I wrong about
We
that?
don't know that.
Mhm.
CZ has literally said by himself, do not trust exchanges that move funds out of proof of reserve wallets within 24 hours of doing the reserves. And then within 24 hours, 2.7 billion tethers moved out of Binance Cold 2 on Tron and into this mystery wallet where there's still 1.3 billion of it remaining. I don't know who that is, but I think it's Binance because the wallet was made with a Binance address. If you go to CoinMarketCap, you look at the market cap of USDD over the past year, you will see that at some point it leveled off at 725 million very quickly. It's gone sideways for months. Now it has spiked above it and it has collapsed back to it, but it's been at that level for a month, which is almost the exact level that the burner contract says that they have. Basically, they just at some point programmed in this number, froze it, and now they're lying about it.
It looks really bad. The USDD chart, like it's kind of faltering, like getting ready to break. Like the peg is totally broken.
There is no money in the peg stability module. You can look this up in their collateral details. There's 4 USDT in there. Literally 4 USDT. 4. That's why it's not stable, because there's no money to stabilize it. Why aren't they selling the TRX? Because it's Justin Sun's token and he wants to keep the price up.
Crazy.
If TRX collapses, his empire collapses and his scams bubble to the top. So if you're wondering that if Sam Bankman-Fried was either the last one or the biggest one, no, not by a long shot.
Wow.
I don't know if Justin Sun's going to finally collapse in 2023, but I damn sure hope it does because he is hiding behind diplomatic immunity and it's time to go. The last thing I haven't talked about, I just remembered, is because we were talking about it before stream. So I thought, or before the camera was on, so I thought I already talked about it.
Yeah.
Is that I might have figured out where Tether's liquidities come from. And I'm pretty sure I actually have. Now, I found something out about Tether, and you can check this yourself. If you load up the Coinbase USDT to USD pair and the DXY on this website like TradingView, you compare them directly, use new price scale, so you don't see percentage differences, but you see the pattern of the lines. You zoom in between the May crash and the FTX crash. So there were 2 DPEGs on Tether, and you zoom in right between them so the chart doesn't go haywire and you get very small lines. You're going to find out that with an extremely high correlation that you would not expect, Tether inversely correlates with the DXY. What that means is that it's effectively an inverse dollar. But Tether is supposed to be one-to-one backed by dollars, so how can it be an inverse dollar? And the price patterns here are very exact. What the fly in the ointment in my fly in the ointment is that I never considered there might be a very large euro-dollar player out there which doesn't have a country, which doesn't produce anything, and it's basically just a scam, and those dollars are never coming back. So if Tether, even if it's just half of Tether, meaning the Ethereum chain, which is about $31 billion, $32 billion, somewhere around there, if it's just that is euro-dollar loans. And that market is 7-12 trillion, somewhere around there. It's big enough to hide them. It's one of the few markets actually big enough to hide them, and I'm kicking myself that I didn't think of it earlier. If that's really how much liquidity they've drained from that market, and now it's not going to come back to that market, that means that everybody else active in that market now has to scrounge for liquidity, which means dollars, which means a DXY spike. I can't even say for sure that the DXY spike into 114.6, I can't say for sure that was not Tether scrounging for more dollars. Sure, the energy crisis and the war helped. Sure, it helped. but it can't explain everything. I thought that at one day they would just lose their banking, lose their fiat off ramps, and crypto would be a Hotel California scheme where dollars enter, but they don't leave. So everybody tries to sell the crypto, but you can only sell it for other crypto. Nobody can find any dollars anymore. So the price eventually just drops when everybody gives up. But now, if it turns out that Tether has $30 billion worth of Eurodollar loans that are not coming back because there's this giant Ponzi scheme that just imploded, it could have ramifications for the traditional markets too. That could be a true black swan that nobody sees coming. Well, nobody. But I genuinely mean that. This is something that scares me, and I've been around the block. I can't say for sure that it isn't the case. There is a non-zero chance that I'm right. I want to be wrong on this, because if I'm not, there's either one or two things can happen, and I'm not entirely sure which one. Well, one, because everybody scrounges for dollars that are no longer there. The DXY is going to go absolutely through the roof, and we're going to see 150 on it, and Brent Johnson's going to be right on this milkshake theory. Or two, because it was actually Tether scrounging for liquidity all along that made the DXY spike in the first place. We've already had the milkshake theory, and the moment Tether collapses, the dollar does as well. Because that dollar demand that used to be there, Tether trying to desperately survive, suddenly has gone away. Just like when Tether, when you've got 80% of Bitcoin demand denominated in tethers, and Tether goes away, 80% of your demand goes away, at the same amount of supply, your price drops 80%. That's just how it is. So if there's Tether demand in the DXY through Eurodollar loans, and that blows up, the demand in the DXY goes away. That means dollar demand goes away. That means we're all fucked. And the DXY isn't going to go to 150. It's going to go to 80 or 90 or 70, anywhere around there. I cannot say. I know it's a range, but if I'm right, it's a range of extremes. There's no middle moderate ground here. It's going to be a fuck up of epic proportions. So I seriously hope I'm wrong here, but I cannot for certain anymore say that I'm not right.
It's a new age of crypto and fiat currency blending together.
I always thought the fiat off-ramps were nothing more than Kraken and Coinbase, and that was it. But I also have never, ever, ever been able to really explain their dollar liquidity source. Every Ponzi out there has a limit. And if it's a dollar-denominated Ponzi, it's a dollar limit. If it's Euro Ponzi, it's a Euro limit. You get that. Tether is dollar denominated, so there is a dollar limit. They have to continuously get inflows. So Ponzi doesn't just work off greater fool theory. It only needs more capital. So if you have the same fools investing even more capital than they already did before, the Ponzi is also sustained. You don't just need new investors with new capital. You just need to have more capital. So, yeah. In 2023, they won't be able to attract more capital. The Greater Fools has already run out, and now they're using their wash trading mechanics to drain as much from the pegs or the currency pairs as they can. But that is only so much liquidity still left in the market.
Could a pivot and a rush back into high risk assets save them?
Yes, technically it could. But it would also require people to put their legitimate dollars back into crypto so Tether can siphon them off. If everybody just buys Bitcoin directly and it doesn't use a Binance to do it or a Tether listed, very simple. Let me just, we're going towards the end of the video here, and now I'm also running out of time. So let me just give advice to the crypto community at large for this, on this particular aspect. Don't use any exchange that lists any pair using Tether. Now, I'm not too keen on any of the other stable coins, especially not the Binance one. Stay away from that. But I can't say for sure that USDC, for instance, is a giant Ponzi scheme. Like, maybe they have a hole of a few billion, but I'm not any sure on any of that. So even if that means that you simply have to sell all your crypto and stay out of it for a while, this is an ideology thing. And if you keep supporting fraud, fraud will not go away. So don't trade on any exchange that lists any pair with tethers. That's all you need to do. If that means that you cannot find a single exchange to trade on, you know what that is? A gap in the market. Capitalism. Isn't this supposed to be about capitalism? Competition, baby. Start your own fucking exchange. Can't be that fucking difficult. Has to be open software somewhere for a decentralized exchange. Come on, people. It's not that hard. Vote with your wallet. Literally vote with your wallet. Just don't connect your wallet to anything that lists Tether.
Fair enough. So where can people go to stay on top of these updates as all this unfolds?
Now, my main place to find me is Twitter still. I've considered alternatives, but they're nowhere near good enough for now. No, Twitter is where the battle is. So on Twitter, you can find me at Deso Games. Next up is Twitch. I stream twice a week. I'm about to stream tonight as well, but you know, they'll be long after this video airs. But you can find me on twitch.tv/Deso Games. I generally stream 2 times a week, finance on Thursday and Saturday, but at the moment I'm having kind of a semi-break. It's the holidays, so on Saturdays I'm doing game streams. But the finance streams are quite popular on Thursdays. Next up is my Substack, desogames.substack.com. And that one's actually important because by the time this video goes live, I will have posted the white paper to Research Coin, which is my own crypto system. I didn't program it, but I did think it out completely, wrote down the blueprint in a book, and it's been on sale for a little over a year now, published in August 2021. Elliot has read it himself, asked him to proofread it.
Yep.
So he knows quality. Yep. And I feel it's time to bring some hope back to the people, and Christmas is time to be generous. So I wanted to give. I have not had anybody argue with the system or my views. I've only had great support and great comments about them. So what I'm revealing specifically is the system itself, how it's all connected, what you need to program in where in order to make it work as I envisioned, in order to basically upgrade Bitcoin to Bitcoin 2.0. All the current crypto will die because they got the utility question wrong. Even Bitcoin has its flaws that the maxis just don't want to admit to. Why? Because Saylor is like $2 billion in the hole, baby. He needs this thing to go up. Like some of these people have accused me, or some people on Twitter have accused me of not believing in my theories because I never put any money down on it. No, I just don't want to invest in obvious scams and scamsters and conmen and false idols and all of that. It's a pure ideological thing to not put my money in until all of this is fixed. But I also created my own system to show that crypto and even Bitcoin, because I still use Bitcoin as a base because it's open source software and anybody can use it. But other crypto can be used as a base as well. This is a system for everyone, literally everyone. I try to take into account everyone. So give it a read on my Substack. And when this system takes over, or derivatives of this system take over, because I left plenty of knobs to tweak. There's some things that obviously need to be the way they are, but I've also given directions in this is where you can still tweak this or tweak that. Once the system takes over and crypto has another 5 to 10 years in the oven, I think it's going to have a hell of a future. I think it's going to be our main weapon against CBDCs and the lack of value they have. I really do. But then we need to make sure that we fix the final problem of Bitcoin, that being that the work it does in order to keep its security, I know why it's necessary, but the fact that the work it does is nothing more than, is this the right password? No. Is this the right password? No. Is this the right password? No. Is this the right password? Yes, you get Bitcoin. Is this the right password? No. Is this the right password? No. This is the right password? No. That's all that it is. Petahashes means that it's happening a billion, a trillion, or quadrillion times per second or something, but that's still all it's doing that many times per second. If we can just redirect this to the work we already do on a daily basis. That being the supercomputers that all the governments are constantly building everywhere to develop nuclear technology, biomedical technology, weather models, AI, all of that. Innovation. If we can just replace the empty work in proof of work with mathematical research and turn it into proof of value, stuff that we know has value because innovation improves all our lives, then we can finally fix the final flaw of Bitcoin and all the crypto, the reason why they've all collapsed now, and give it true utility. I'm not saying that my system is the final one, but I'm saying that it will be the base for the next generation of systems, just like Bitcoin was the base for the first generation of systems. I'm publishing chapter 5 out of my 3 books. The first 3 books that you can find links in my bio on Twitter on where to buy them. The first 2 books are the definition of money and the definitions of value. I've wrote those 2 books and the first half of the 3rd book specifically to show that I know what I'm talking about. I understand value. I understand money. I understand it all. And I've congealed it all into this crypto system that works. I know it works. And I'm publishing the first page of chapter 6 in where I give up the patent rights. I think that's kind of important to mention, that the system is in the public domain.
Wow.
Anybody can make this. I have no desire myself to be in charge of the global world reserve currency because it's way too much political hassle. I've got other things to do. I'm starting my own company that's based on another invention I've made that's also quite bitching, if I do say so myself. And this one is free for all. If I make enough money with my own company to basically hire a few crypto bros myself to program this shit for me, I'll do a throw at it in a couple of years. But I don't want to let the rest of society wait on me. I'm not greedy. I don't give a shit about the money. I want it to be free. I don't want it to, people to receive it free. No, I want it to be free so that everyone can enjoy stable prices. Free of government manipulation. The reason why Bitcoin was designed in the first place. That type of free. Yes. And it can only happen if it's not proprietary, because if I keep the patent rights, it's only going to be a matter of time before something happens to me. I die, it moves off to my family, they sell it, and then suddenly Bill Gates buys it. Now he's in control of the world's money supply. I have to give up the rights, and I have to make it available to all so people can compete with each other if anybody becomes tyrannical. And that is what I've done.
It has to be decentralized.
Even the information has to be decentralized.
Mm-hmm.
All I ask is that people buy the book for the rest of the explanation, because I spent 10 years trying to figure this the fuck out, and I think I can charge $30 for it. Anyway,
thank you so much for stopping by.
Thank you so much for having me, and hopefully not until next year, because, we should do more videos.
This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.